Welcome to the Rim Break Rodeo. We hope this video helps.
In this video, I will explain how to play call and put options in the share market. Options are financial contracts that give you the right, but not the obligation, to buy or sell an underlying asset at a predetermined price, called the strike price, on or before a specific date. You pay a small fee, known as the premium, to acquire this right. It's a versatile tool for both speculation and hedging in the market. A call option gives the holder the right to purchase 100 shares of an underlying stock at a specified strike price before the expiration date. You would typically buy a call option if you anticipate the stock's price will increase significantly. For example, if a stock is at $50 and you buy a call with a $55 strike, you profit if the stock goes above $55 plus your premium. Conversely, a put option gives the holder the right to sell 100 shares of an underlying stock at a specified strike price before the expiration date. You would buy a put option if you believe the stock's price will decrease. For instance, if a stock is at $50 and you buy a put with a $45 strike, you profit if the stock falls below $45 minus your premium. When trading options, always remember that they are leveraged instruments, meaning small price movements can lead to significant gains or losses. It's crucial to understand the concept of time decay, as options lose value as they approach their expiration date. Always start with a clear strategy, manage your risk carefully, and never invest more than you are comfortable losing. Education is your best asset.
Thanks for watching. Consider subscribing if we helped you.